So Ken, thanks for joining us. Ken is the chief economist for AGC, and as Joe mentioned yesterday, we've been fortunate to have him present at our annual conference in past years. 2019, Ken was the presenter for Economic Outlook at our annual conference, and we're really pleased to have you back here today to speak with us about what's going on in the economy. Ken, I don't know if you're going to touch a little bit on what's going on in the U.S. regarding the election or outlook there, but I'll let you take it from here.
Okay, thanks. Well, it's good to be back with you folks, virtually at least. And are you going to be controlling my slides? I'm glad to give a cue, but if you want me to take them over, let me know.
And just click on the screen once and it should activate your remote access to advance the slides.
Yes. All right. I wanted to talk today about the surveys that AGC has been doing and then bring in some other data to show how the construction industry overall appears to be weathering the coronavirus, and then look forward at both the immediate short run period and longer run trends in construction. And I'd certainly welcome questions through the chat, or if you're going to call on people after I finish, that's fine. AGC has now done 9 coronavirus focused surveys, and I'm very happy that our membership has put up with all of this questioning. Our latest survey was completed on October 19th and released last week. We got over 1,000 responses, and this slide has some of those results and some comparison with both our previous survey, the coronavirus survey done in June, and a little bit with our annual workforce survey that we do every August, have since 2013. And for this year, we added some of the same questions we've been asking in the coronavirus surveys. To me, the most significant and most alarming result was that 75% of our respondents in October said that an owner, or perhaps multiple owners, had postponed or canceled an upcoming project since March. And that includes many that extend as far out as the second half of next year. That percentage not only was extremely high, but it had risen from 60% just 2 months before when we asked that question as part of the workforce survey, and 32% the last time we did a coronavirus survey in June. Now, all of these percentages are percent of respondents. We didn't weight them by percent of projects or dollar value or workers, but the fact that we asked the question the same way over time, I think, lends significance to the result. On the flip side, only 23% of respondents said that they had won an additional project or an add-on to an existing project. And that percentage has held just about steady. It crept up from 21% in June and the high teens or 20% in previous surveys that we did during the spring. We also have seen a big increase in the percent of respondents who said that they were experiencing project delays or disruptions. And that is now over 3/4 of respondents. We asked them to list whether any of 4 or 5 reasons had been a cause of project delays and disruptions, and also if they want to write in a specific reason. And we found that the leading reason for project delays and disruptions this time was a shortage of construction materials, equipment, or parts. That had jumped to 42% of respondents from 1/4 of respondents in June. And over half the respondents, 550, I think, wrote in specific items. And it was all over the lot. Certainly those who use lumber were experiencing problems with the lumber supply, whether it was oriented strand board or plywood, but also aluminum, steel were mentioned fairly often, but then a lot of very specific products, appliances, if they were doing multifamily, and many other things that go into non-residential construction, as well as mentioning problems with trucking deliveries and for imported items, ports. The problems seem to be across the country as well as international, and across all kinds of manufacturers, suppliers, and transportation sources. The second leading cause of delays and disruptions this time was the shortage of workers, either their own or subcontractor labor. And that percentage had not changed since June. At that time, that was the leading cause. The one thing that has gotten better, steadily better since early spring was supply of PPE. That was the leading cause for delays and disruptions at the very beginning, but has now dwindled to just 7% of respondents listed that as a problem area. The question about when would business return to normal relative to a year ago has stayed fairly steady, but gotten a little bit more positive. This time, 35% of respondents said that they were already back to year ago levels or exceeding them. And that just barely beat out the percentage who said they don't expect that to happen for another 6 months. In previous surveys, people who thought it would take more than 6 months exceeded those who said they were already back to normal. And then a question that we've asked on the workforce survey each year: are you experiencing trouble filling craft positions? Previously, 75 to 80% of respondents said yes. We asked about 20 specific craft positions, and generally almost every position, a majority had said they were having trouble filling that position. This time, a little over half said that they were having trouble filling one or another craft position. That was down from 80% to 52%. And there wasn't a single craft that more than half the firms were having trouble filling. On the salaried side, it was somewhat similar. A big drop in the percentage who were having trouble filling positions from 57% a year ago to 28% this time. But 80% of those who were having trouble filling one of the 9 salaried positions we asked about, 80% said they were having trouble filling project manager or supervisor positions. And that was even higher than we've seen in past years. Well, let me broaden the lens to talk about what we're seeing in the BLS data on construction employment. We'll get October figures tomorrow morning. What this slide shows is the huge drop in construction employment from February to April, and then a recovery that began sharply but has taken 2 different directions. As you may know, the Bureau of Labor Statistics reports on 5 different sub-industries: residential building construction, that's home builders and the general contractors who concentrate on multifamily construction, and residential specialty trade contractors, whether they're doing new work or renovations and additions. We add those together for what looks like a yellow line on this graph. And then on the non-residential side, it includes building contractors, specialty trade contractors, and heavy and civil engineering firms. And that's the red line here. So in those first 2 months, the industry lost 14% of the employees it had at the high water mark in February. That was over 1 million workers who lost their jobs in just 2 months. Strong rebound in May, thanks to quick and widespread adoption and use of PPP loans to bring workers back who had been furloughed, and also because governors, mayors, and owners stopped the stop work orders that they had put in place. And so companies were able to resume construction projects or start up construction projects that had been halted. But by June, we were starting to see a difference between the residential and non-residential sides. Home building really picked up speed. Home renovations seemed to be going on everywhere. But on the on the non-residential side, things were beginning to slow down. And since June, non-residential construction employment has been flat. It's actually down 0.2%, whereas residential employment has continued to grow at a rate of 1% a month, a little faster than the bounce back in the overall economy's employment. Well, let me take another crack at how things have changed. This shows construction spending put in place. This is a series the Census Bureau comes up with on the first of each month with a lag of a month and a day. So beginning of this week, we got the September numbers, and I've compared these to February. You can do that because the Census Bureau, like BLS, seasonally adjusts those to take into account normal weather and holiday patterns, other recurring patterns, so you can see the underlying trends. And you can see an awful lot of red on this slide, indicating that most types of construction have had a decline. Overall, construction spending was down just 2%. Now, as the series is called Value Put in Place, it is measuring the spending that takes place on projects already underway as well as new starts. That differs from what Dodge and Construct Connect do, which is to report the entire value of a project the month they deem it to have started, and then they take it out of the database. So their series is more forward-looking, but a lot more volatile. Within that total construction spending, the residential side up 3% from February to September, non-residential down 6% overall. The census also divides things by owner between private, federal, and state and local. And the state and local and federal were both down 4 to 5%. Normally, federal is a very small, insignificant piece that I don't even look at, but there was one noteworthy feature in that public safety was up 13%, whereas the rest of federal was actually down by double digits. And I think that public safety number reflects spending on the border wall and perhaps some immigration detention centers. Let's go to the more significant categories of non-residential. The rest of this slide shows the combined private and public non-residential spending listed in descending order of September 2020 spending amounts. The biggest is a category the Census Bureau calls power construction, and that includes every type of powered generation, transmission, and distribution, but it also includes the construction spending around oil and gas wells and pipelines. And you can see they were both down quite substantially. I think going forward, we may see some pickup in electric power construction, particularly if Joe Biden becomes president and has control of, the Democrats have control of the Senate. We are likely to see a lot more money directed toward things like renewable energy, battery storage, electric vehicles, and so forth. And so I think that would lead to more spending on power. Conversely, I think pipeline construction is likely to taper off or be halted altogether. And oil and gas field construction is generally around new wells that are being drilled. That has really slowed down, though there's been some sign of a slight revival lately. I think that would also do worse under a President Biden than a President Trump's second term. Highway and street construction down very sharply, but it was running at record levels a few months ago. Now, DOTs have had a big revenue loss, toll authorities probably even bigger. We will really need to see if the lame duck session of this Congress or a new Congress puts more money directly toward highway and street construction or passes it through to states, or at least makes up the $37 billion revenue loss that state DOTs estimate they will have experienced through the end of fiscal 2021. Education, you can see two directions here. Primary and secondary actually up a little bit, higher ed down by double digits. And I think this trend will continue. Primary and secondary school districts are certainly struggling, but many of them have been spending money to create more space. I live near a private school that has put up a lot of tent-like structures out on their fields. And so there are examples of that, as well as interior remodeling. And as more homes are built in outer suburbs, as more people relocate to non-metro areas or to smaller metros, I think that there will be even more demand for new school construction and school expansion. On the higher ed side, we've had this huge drop in students on campus, a huge drop in revenue from tuition fees, and in some cases, athletic revenue, and a lot of uncertainty about when campuses will get back to full operation. So I think that for both the demand and the ready cash reasons, higher ed spending is heading way down. Commercial is one of those terms that Census uses in a unique way. For them, it means retail, warehouse, and farm construction. And you can see a not very surprising dichotomy here. Warehouse construction up 2%, retail down by double digits. And I think these trends also will continue. To the extent that retail is only down 10%, it reflects the fact that there is some renovation going on, either to create more safety or to bring in a tenant that is succeeding. But I think some of the warehouse construction, in fact, will be taking place in big box stores, anchor stores, and malls, and so forth. Office construction looks like it's only down 3%. But again, this reflects the quirk in how Census classifies categories. They set up these categories in the 1960s when the term data center didn't exist, at least in my vocabulary. What you had was a room with a false floor and extra air conditioning and mainframe computers, but it was in an office building. Now we have these buildings where nothing is there except electrons, but they're still in the office category. And I think they're the strongest part of what Census calls office construction. Unfortunately, they don't break it down. But I do think new office construction has really hit the skids and is likely to stay down. Manufacturing is a mixed bag. We've seen a couple of small increases, but also some very large decreases. And I think it will continue to be a two-part story. And then transportation structures, not surprisingly, airports in decline. And I think as current work finishes up, we'll see even fewer new starts on airport construction. Big drop also in freight, but I think that as trucking has come back, we'll probably see some more investment there, perhaps in rail. And mass transit, while it's up by the largest amount of anything here, I think that reflects legacy projects that will not be succeeded by anything of the same scale. Well, let me give you one other perspective on what's happening. This again is from the Bureau of Labor Statistics. It's producer price indexes. And there are two types here. The one in yellow is what I call a bid price index. Formal name is the Producer Price Index for New Non-Residential Building Construction. And BLS puts it together by asking the same frame of contractors each month, what would you charge to put up a particular building? And they're asking about the same building they asked about a month ago and a year ago. They don't ask the contractor to work up an entire estimate, just what would they add on for overhead and profit. And so you can see that this index has stayed just about flat ever since April. In contrast, the indexes that track the cost of all inputs, whether it's materials or services, including wholesaler services, trucking services, and so forth, has gone up very sharply, much more than overall price indexes. For non-residential construction inputs, it's risen about 1% a month for 5 months. For residential, up more than 1.5% compounded. And that reflects the lumber and appliance shortages and the big increase in those prices. To summarize so far, we've had this enormous job loss. 14% of the February total, that 1.1 million jobs, was half as many as the industry lost in an entire 5-year period from 2006 to 2011. Strong rebound, much more so than the overall economy, which has recouped about half the jobs lost, but an increasing dichotomy between residential, which is almost back to its February employment level, and non-residential, which is down, stuck at half of the job loss being recouped. PPP loans certainly helped firms reduce that job loss, but now those loans have been used up. They're only good for 24 weeks of payroll. And unless we get an extension and renewal of the PPP program, I think more workers are going to be laid off as we see more projects finish up and less new work available, more projects postponed, sometimes indefinitely, or canceled outright. As the recovery begins, what will happen to different parts of construction? Well, first of all, I think it's going to take some time for economic recovery and longer time for construction recovery. Before we have a sustained economic recovery, we need to have a vaccine that is proven safe, effective, available, affordable, and the public is actually willing to take it in large enough numbers. Even then, I think we'll see a very mixed picture in which businesses come back how quickly. And for construction, any type of owner, whether it's a private business that was planning to add a new facility, a developer or landlord or investor that's lost a lot of rents, an institution like a university, or a public agency that's seen a big drop in tax revenues. I think they're all challenged as to where they'll come up for the funding, and also whether the demand will be there to warrant going ahead with new construction. The best private prospects continue to be in the remodeling of offices and many other facilities for distribution centers. As you know, Amazon alone has said that they plan to build 1,000 or remodel places to get closer to customers. Data centers, again, we don't have data specifically on them, but plenty of reports of large new data centers being built. But much less demand for retail, offices, higher ed, probably cultural facilities, athletic facilities, certainly less for lodging, other travel-related facilities like convention centers. On the public side, I think it really depends on federal funding, whether we get a new stimulus bill, whether it's limited to transportation infrastructure more broadly, or just support for state and local governments that will enable them to go ahead with some building projects that otherwise they would probably cancel, because it's always easier to cancel construction than to lay off workers or cut existing social programs. Let me finish by going a little further out. Post-pandemic, and I hope that comes soon, but I don't have a prediction about that, we're certainly likely to see slower population growth. That's been the trend over the past decade. The birth rate keeps coming down. More people are entering older age categories where the death rates are higher. And immigration, at least for now, is way down from where it was at the beginning of the decade. That means less demand for houses, for retail, for consumer services, schools, and other public facilities, and also a slower revenue growth for state and local governments. In addition, the shift from retail to e-commerce is not going to reverse, and the need for having distribution structures close to customers will stay in place. The structures themselves, I think, are likely to change shape, that we'll see more automation inside them, more use of drones and autonomous vehicles to deliver from them or bring things to them. So the footprint may shrink and the roofs may go higher. In terms of healthcare, we've seen two major blows to that sector. First, that people were kept out of hospitals. They still have not come back as much as they had before coronavirus. And certainly nursing homes and long-term care facilities are places that people are trying to avoid as much as possible. And yet we will have more people aging who can't just stay in place, probably more long-term care needed or chronic care for people who have lingering symptoms from a coronavirus. And it remains to be seen what kinds of new facilities will emerge to treat them. Now, K through 12 schools are a category that should come back to previous levels of demand, that we have the same number of kids as before. By and large, they're going to school in more or less the same places, although it does look like there will be more construction at the outer fringes of metro areas. And that means that new schools are needed to serve those populations, but there will also be continuing demand for renovating existing buildings and adding to them. But other kinds of public construction, I think, are going to lag unless we get sustained federal infrastructure and public construction spending. And I don't see any sign yet that will happen beyond what we may see in the first 6 months of a new Congress. Where will people be located? It's too early to tell whether the outmigration from dense cities is going to last. But in general, we've been seeing this kind of trend over the past several years, and I think it will continue, if not intensify. The states in red, this is the population change from July 2018 to July 2019. The states in red, there were 10 of them, lost population. The states in pink, the entire Northeast, California, had very slow population growth, less than 0.5%. Instead, growth rates matched or exceeded 1% in the Southeast, Texas, Colorado, and Washington, and they were 1.7 to 2.1% in the 4 Intermountain states of Idaho at 2.1, Nevada, Utah, and Arizona at 1.7%. A lot of that is fueled by people moving from California, and it's possible that California will actually slip into the red when we finally get the 2020 census figures later, either late this year or sometime in the first quarter of next year. Well, that's my story. I'm sticking to it till I get new data, and when I do, I'll put it in the Data Digest, my weekly one-page summary of economic news relevant to construction. Be glad to add anybody on this call to that. Just email me at ken.simonson@agc.org. And you're also welcome to visit the agc.org/coronavirus website to see lots of information about what contractors are doing, what the guidance is, and also results of our surveys. So let me turn it back to you and see if there are any questions.